Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, joined here once again with Dan Michelon. How you doing, Dan?
I am doing great. Enjoying the weather. Pollen's finally clearing out. You know, getting ready for summer here.
I don't know that it's clearing out entirely from my voice. But we're here with you today. Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You know, one thing that we focus about with our shows is that we really want this to be informational. We want people to really be able to walk away with knowledge and value. And we believe that investing is all about you finding a successful experience, no matter where it is that you go to get your help. And we feel privileged to have you listening to us and learning about the things that we have in front of us. Today, we have a pretty valuable show that for a lot of people is going to bring value, even though the market has been down for a lot of people. You know, when you lose money in the market, people start running away and they get scared and they don't know what to do. And our show today, titled Gaining from Your Losses, is something that I think is really going to help people figure out how to maximize value, not just in their portfolio, but specifically, you know, harvesting their tax losses. And I think that's one piece that a lot of people are not really thinking about the value of an opportunity like right now is for them.
There could be stocks or investments in your portfolio that you really like, but just given the circumstances and where the market's gone, they're down right now. And that's inevitable in a lot of instances. So there's some techniques around, you know, maybe exit that position now, you know, kind of book that loss with an eye towards your taxes at the end of the year. But then sometime between now and then, at least 30 days from now, you get back into it.
Yeah. And that's a strategy play that, you know, needs a little bit of oversight. But we're going to talk about that today. We're really going to drive home the idea of how to make sense of all of this in the midst of kind of fear of missing out. And that's a common thing. But before we get jumping into that, we're going to run right into money in the news.
And first up, we've got from CNN an article here from Peter Valtez Dapina. The title of it is, An Electric Car Finally Makes Financial Sense. Now, that's kind of a good news, bad news scenario, I guess. But as we've discussed here on the show many times, and every one of us out there is well aware of, gas prices continue to rise, and there seems to be no indication of that letting up anytime soon.
Yeah, California, almost $10 a gallon now in some places.
I saw $4.99 this morning driving by here in New Hampshire and just almost choked at the sight of it. It's insane.
That's just ridiculous. I can't even believe it. But, you know, I think we've talked about, you know, why does an electric car finally make sense, financial sense, and the idea that the electric car prices aren't going down, Dan.
No.
And they haven't dropped at all. As a matter of fact, they're going up. So why is it getting cheaper? You know, obviously people think of the idea that, you know, hey, I don't have to pay for gas, or in a hybrid scenario, you don't have to pay for as much gas. And I've believed this for a long period of time, that we couldn't make electric cars financially sensible without making gas more expensive. So, I mean, from an agenda standpoint, I think this kind of proves that point.
Yeah, it's it's scary to think about maybe some of the underlying intentions here, but you would certainly hope that we wouldn't be forcing people through this much pain and expense to meet those goals. But the reality is, you know, for whatever reason, the math is simply starting to make more sense.
I mean, I obviously am hoping for, you know, midterm election kind of swing, and I'm hoping that maybe there's going to be some remittance in the oil world to make things more affordable. That's my long-term personal hope at this point. I think everyone hopes that. I don't know that they know which direction we need to go for it, but in that process, I do think it's interesting that even with the electric cars costing more money, some of these companies actually still have rebates. And that's one of the things that the article drives into, is the idea that you can get in some models, and they're talking about a BMW 4 Series, is still eligible for a $7,500 tax credit, not just a deduction, but a straight up credit of taxes. So if you owe $10,000 in taxes, you're only going to owe $2,500 now. That type of credit.
Yeah, I mean, I found the title, I was a little skeptical and just taking a look at it, but pretty quickly they walk you through the math, and it's it truly does add up. I mean, they say the difference on average between the gas car and the EV model is about $10,000, right? They immediately get that $7,500 credit, right? So take that off the math, and they say the price comparison on according to the EPA, the average cost of filling a tank for over the course of a year is $2,900, whereas the average charged car costs you about $600 per year. So this 23 of the other 25
you're basically
accounted for right
even
there. So now you're even, and that's only in year one.
Yeah. 12, 13 months you're even. I mean, I think that's interesting. I think what I find to be the most ridiculous portion of this thing is that Tesla and General Motors, which I believe has, we were talking about this before the show, has overused their number of tax credits or something like that. So if you buy a Tesla, you're not going to get a tax credit.
I know.
I think that's hilarious, to be honest with you.
It doesn't make sense, but buyer beware though. That's something to keep in mind. Don't presume you're going to get that credit because it's an EV.
Yeah.
Make sure you're asking about that at the dealership.
And that's a big deal. And I think if oil and gas is not mitigated in its in its price and so forth, and obviously EV vehicles will become more valuable, and I mean, it's obviously going to send other vehicles down in value, but that's until we get supply chain.
Yeah, I mean, I don't think there's any doubt that it was the way of the future, but it's seemingly the future is now.
Yeah, I think it's a good point, and I think that my wife and I have been looking at cars, and 2 kids off to college, and we're looking for smaller vehicles and less gas guzzlers, and we're looking at EV vehicles, and this is all part of the conversation that we're having. We're like, hey, you know what? We go back and forth to the store 10 miles, and we do that 50 times a week, it seems like. So, if we can cut that gas out, and guess what? Driving around town is the biggest gas guzzling portion of your driving. So, yeah.
It makes sense.
It makes sense in this marketplace, So, right now, it's a tough world, and a lot of people are suffering from this. So, next up, we have, and this is something that's really interesting because we're going to talk a little bit about dollar stores. But it's interesting because the stocks have been moving crazy fast in this area. But rising prices are pushing shoppers to dollar stores by Nathaniel Meyerson. And this is also a CNN article. And it's really very interesting because the consumers are being, every time we buy something, people are looking at the numbers. What are you buying? What are you focusing on? And Walmart, Target, all these different companies have been noticing that people are moving away from the less essentials. They're spending the same money, if not more, but they're focusing more on the core products, the food, the non-discretionary items. I thought that was interesting.
Yeah, no, people certainly, are more intentional with their shoppings. I think the word they used, and I've noticed that myself, and our household, shopping and spending habits. It's just, when it finally dawns on you, the average trip to the store is, $50, $60, $70 more than it used to be. You can't help but kind of pare down that list a little bit.
Well, I remember I said to my wife, I go, you could never go to Target and not spend $100. I was like, why don't we just, instead of going to Target, 2 times a week, let's just go to Target like once a month. Just because it was like every time you went, it's like, oh, I need this and I need that. And it just multiplies. I mean, the marketing is so good. It's like, oh, this is right on the aisle. Exactly that time of the season, that time of the year. Oh, I need, I got family coming for Christmas. We should get new Christmas plates or whatever this, I'm like, no, we don't need it. So.
Oh, so many painful conversations. I can't even.
So anyways, but to change the topic a little bit, they are noticing that people who are going to the Dollar General stores are kind of moving away from you kind of go from the Target or Target to the Walmart down to the Dollar General. Not that there's a difference in really care or brand, but there's just people are just looking for affordability. And Dollar General and I can't remember what the other one is. We're seeing huge stock spikes.
Dollar store. Right?
Yeah, Dollar Store. Yeah. Huge stock spikes due to the interest. Even though shipping and costs and all that stuff are relevant, people are just looking for the most economical necessity supplies that they possibly can.
And part of the article hints to, and it references that since the Great Recession, the $3 chains have grown faster than virtually any other retailer. And particularly, they've put more stores into rural areas. So they've targeted kind of the lower wealth, lower income environment to place these stores, which, lucky enough for them, with the increased gas prices, that's where people are going to go.
Yeah, they're just going to drive to the closest store that they can get at the most reasonable. Why would you drive all the way to Walmart if Dollar General's right down the road? And it's funny because we were talking about that. My wife and I drive different areas. You're like, there's no Walmart, there's no Target, there's no store, but there's a Dollar General in the middle of nowhere.
Yeah,
it's really very interesting.
Yeah, these guys were wise to kind of figure that out, and it makes sense with their business model, right? The lower price, so you think it would be a natural fit. But this gas issue has certainly just played right into their hands. It's probably a big part of that recent spike in sales.
Yeah, absolutely. Next up is probably an article that is going to drive a show in my mind, and as time comes on. But I want to talk a little bit about home affordability. This article is titled "Home Affordability Has Collapsed in 2022," and this is what to expect next, according to Bank of America. This is written by Joy Wilthermuth, and I think there's such a huge conversation about kind of the 5 moving parts. I'm just throwing out a number of all the things happening in the real estate world all at once. Like the world is just in huge, huge turmoil and people trying to figure out what's going to go on. But this article very specifically says existing home sales tumbled 33% in the wake of 1987 and 45% in the aftermath of the subprime mortgage crisis. And they think that potentially a 35% peak to trough home sale decline is plausible. I would totally agree with that, if not more.
Well, I mean, certainly when you see the prices, and I think probably the more important part for the majority of the market, excluding your cash buyers, is that the mortgage rates have doubled in just a year. So up over 5% on average, which is incredible. It is
crazy. It is crazy scary how high they've gone. And I think there's a real fear, too, that we're far from the top of that mortgage crisis. I was talking to this guy the other day, and he said, well, you can get a 10-1 ARM, a 10-year fixed with a 1-year adjustable after that at 4.75. And I was thinking to myself, man, in 10 years, I think it'd be like 10%.
Please don't. That's the one thing I'm very happy about is refined into fixed.
Yeah.
And I mean, I think that's going to be like gold.
Yeah. I think that is gold. And it's really hard to quantify what's going to happen here. But I think at the end of the day, and I talk to people all the time, and I think whatever you can sell your house for now is probably going to be a very nice peak range for a very long time. I just don't see rates coming down. If anything, I think the Fed raising rates, I've said this multiple times, is probably going to backfire because the demand is already there. The supply is not. And we're still trying to backfeed all the previous demand still in a lot of this stuff. So I'm really very concerned that we may not just halt our economy, we may send ourselves into a tragedy potentially. I mean, it could be really horrific. That being said, when you start looking at all the different moving parts here, when you can afford a mortgage, if your mortgage is $2,000 a month and you've allocated $500 a month in property taxes, well, that means your principal and interest can only be $1,500 a month. Well, as that interest rate goes up, it takes more of that $1,500 a month away. So therefore, whatever the principal piece is going to get smaller. And that then therefore dictates what volume of house you can buy, because the bank is just saying you can afford $2,000 a month. We don't care how you break it up, but that's mortgage, taxes, insurance, interest and whatever. So that's your number. And the one moving part to all of those is just the house price. And so as that interest rate starts skyrocketing, those house prices are just going to be tumbling. But right now, which is really interesting, is there's enough cash on the market that people are still buying and there's not enough supply.
And that's the article points to this, because looking into it a little deeper from the investment perspective, they say, in these two other periods in time, in 1987 and 2008 and the subprime mortgage crisis, when the housing market was facing similar conditions, it resulted in stock market collapse, some serious drops in the market. But the indication and the kind of the end of the article is that while there might be some pricing pressure, the supply is still limited and the demand is still very, very high. And there are still tons of people with cash who the mortgage rate and situation just doesn't apply to necessarily. So they don't know that kind of previous predictor is going to come true this time around.
And I think that's the unknown, right? That's the piece that's just not like so obvious in front of our faces, because the truth is that people have settled into their 30-year mortgage saying, I don't want to refinance out to something twice as much that I'm going to buy nothing, So I look at Home Depot stocks and Lowe's stocks as being a real opportunity potentially right now. I mean, that's interesting because people I see fixing up their homes more than buying a new one. Right. Become comfortable with what you have. So that being said, you have that huge piece to it, but that reduces supply. If you don't want to sell your house, you don't sell your house.
Yeah, and they said we've kind of underbuilt for decades, and now this, like everything else that we weren't necessarily properly planning on, now we have this just massive crunch and this competition and just demand gone crazy.
Well, that's interesting too, because I would say I think we've underbuilt homes, but we haven't underbuilt living environments, because you see all these. I mean, we drive through Boston, you see all these new condo apartment complexes going up everywhere. They're beautiful, gorgeous, because everyone was moving to the cities, and they said, hey, for years our parents were never making money on their real estate. They were breaking even or losing dollars, and we didn't see value in it. Now we're in a real estate boom again, and people are making money, and people are saying, hey, next pandemic, I don't want to be stuck in the city again. They're buying their homes, and they're saying, I'll have a second home here, or I'll do this. So there's not enough. I mean, more people have two homes now than ever. I used to think, remember when we were kids, everyone had one car? You had one car. Well, you have two cars. You must be rich. Now everyone wants two homes. You want a place in the city. You want one in the woods. It's
a place to run away to.
Yeah, it's kind of an interesting.
Yeah, I was just driving through where I grew up this past weekend, and the construction there it's insane. The streets just don't even look similar anymore. And a buddy of mine was saying that there's $6,000 a month studios there in Newton. You're like 500 square feet for $6,000.
That's the hood, right? That's the hood.
Oh yeah, must be rough.
Well, that's going to do it for Money in the News. We're going to be right back with maximizing gaining from your losses, and how to deal with the market today. If you're dealing with, hey, listen, I've got this loss, I've got that loss in my portfolio. How can I make the most of that today? What is it going to do for me long term? And we're going to talk a lot about that and tax loss harvesting and all of those pieces coming up. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You have real estate. You have real estate questions. You have commercial real estate. You're wondering about liquidating, things of that nature. Give us a call at 855-226-8551. We work on those things for you. So we look forward to talking with you. Stick with us. We'll be right back.
Folks, it is so much fun for us to bring you Money on Tap. My name's Seth Cressman, and I am one of the hosts here at Money on Tap. I'm also a financial planner. That's what we do. That's what Ben and I do. And the fun part is we get to have this radio show. We talk about important things that we think you need to listen to and be aware of to help raise the bar as far as your financial literacy. It's a big part of what we're trying to do here. The other thing that we're doing here as well, as financial planners, we are welcoming you to come and call us and to join us at Brayshaw Financial Group. Experience what complete wealth management looks like. Let's take a look at all sides of the issue, get a three-dimensional perspective, and put a plan around your next step. It's so critical. And so many people just leave this part out and then they find out later, oh, if I only would have known. Hey, don't let that be your story. Give us a call at 855-226-8551 or info@yourmoneyontap.com. If you have $250,000 of investable assets today, our plan is free to you. We think it's important for you to know the facts and have a playbook so you can have a successful retirement. Give us a call at 855-226-8551. Thanks for listening.
Now back to Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, joined here with Dan Michelon, and we are working through gaining from your losses. You know, this market has been brutal for people. I mean, we've heard from people that have just lost a bunch of money through this, downside, that don't have precautions set in their portfolios. We've used things like the 200-day moving average as a slider to get out of the market. We've used high yield portfolios to offset some of the bond issues with the raising rates. There's a lot of things that are going on that kind of the average investors don't traditionally use or know about or have the wherewithal to have that connection. So this show was generated out of the idea of how do we still help you? How do we still create value out of how do you move forward from here and try to maximize what you do have and maybe because just because the market's down doesn't mean that all is lost and that there's not opportunity to figure out how to both manipulate your portfolio and positively direct some of your taxes.
Yeah, I mean, the market's going to be up and down and essentially do what the market does. But that's not the end of the story when it comes to, what do you ultimately end up with in your pocket, right? There's a lot of strategy and efficiency that can be achieved in any market condition based around taxation, right, and the tax treatment of those dollars, gains and losses, whatever they may be. That's the extra return, if you want to think about it, or the extra savings that working with a professional who understands these things can help apply to your bottom line. And it can have a significant difference in terms of ultimately what your total take-home is. For us, we worry about symbols and tickers and up and down and all that. But for most of our clients, the people who depend on us to help them achieve retirement, really all that is kind of secondary or maybe even meaningless to, what am I getting in my bank account every month?
Right.
That's the number they're worried about. And the tax implications and the tax efficiencies that are out there, they directly impact that number in a significant way.
Agreed. And most of the people, when they actually look to us investors, like, where do we put this money? People don't say, hey, I want you to put it in this or that. They're like, what do we do with this money next? That's kind of the next step. First, I think it would be good, Dan, we're going to go through a number of different, tax-efficient investing strategies that people currently use. Obviously, a lot of people every day have a 401k. They have a retirement plan. It's a pre-tax asset. It's a pre-tax investment asset that grows tax-free. It grows deferred, so you're not paying taxes on it every year. You didn't pay taxes on the money going in, but you pay taxes when the money comes out.
Yeah, and the key notion there of the deferred part of it is that you can trade actively within the account or have someone trade on your behalf without adding to your tax bill in the present day.
Right, which it makes it super lucrative in the idea that you like this stock this month and you like that stock next month, and you can potentially kind of move in and out of these assets with zero tax burden in a today's world, right?
You don't need to concern yourself with whether is this a long-term hold, short-term hold, does it pay a dividend, is there interest spitting off? It doesn't matter. None of it matters yet.
And it's so relevant to understand this that it's good for our listeners to know that our portfolios, we actually break those into what we call qualified and non-qualified portfolios. So we have very similar, investment-focused, agenda-focused, how they're positioned in the market, but they trade differently, just to maximize return, qualified versus non-qualified. The qualified being the retirement plan money, the IRA, or the former 401ks that have been moved over here.
And that's why some of our portfolios on the qualified versus non-qualified side, we've talked before about the 80-20 mix, right? Yeah. So 80% equities, 20% stocks. Our 80-20. Sorry. 80-20 on the qualified side versus the non-qualified side, they're going to be similar, but it's not going to be exactly the same because we'd be hesitant to trade perhaps knowing that we're going to create a gain across the platform. And if it behooves us and behooves our clients to hold the position a little longer so that it goes from a short-term gain to a long-term gain, those are the kind of things that we keep in mind.
And we do that, and that's very intentional. But I can actually think about, what was it, a few months ago, we bought Microsoft in both a qualified and non-qualified account. We held it for, less than a month. We made...
It was a quick in and out.
It was a quick in and out. We held it in both a qualified and non-qualified. We were in. We made money. We got out. And, and Microsoft happened to decline pretty rapidly after that. But we knew in our minds that, hey, listen, we're going to create a taxable event for everybody in the non-qualified or the after-tax money. We knew that was going to happen. It was a conversation we had, but yet we knew that in the better interest of everything, it was the right move to make. And so it doesn't preclude us from holding everything for 12 months, but the idea that we're conscious of it, I think, is important for people to know, and that's why we're talking about it now.
It's not the primary driver of any trade, but it's a factor we consider.
Right, exactly. So, so you have the 401ks or the IRAs, and that's that pre-tax, grows tax-free, it's tax-deferred, and when you take it out, it's taxable as income to you. But then you have the Roth IRA, which is still considered qualified. It's still considered a retirement kind of qualified asset. It's after-tax money, right? So you could have a Roth 401k. It's after-tax money. But it grows tax-free, grows tax-deferred, but all of it after the fact, including the growth, comes out with no taxable income.
Yeah, this is one of those accounts. I think we just rattled off the 3 qualified accounts that have different benefits, different tax treatment. Thinking of IRA and 401k versus the Roth style of either of those accounts, but all 3 of them do have some limitations applied by the IRS, whether it's on how much money you make, how much you can potentially contribute, and at what age can you access those funds. So there are some rules and some strings attached. But this is the stuff you need to be aware of as you begin investing, just understanding what type of account you're making those investments in. Because as you trade, as you contribute, there's an impact there.
I think of all of these kind of rigid items as more like a funnel. Like your funnel's wider at the top and it's narrower at the bottom. And the idea that as long as you can fit that money through the funnel and it's going to come out right where you want it to, meaning, what age you want, how much you're going to need, all of those different criteria, like that funnel works perfectly. That's what it's designed for. As soon as you try to get, money out of the top of the funnel, it doesn't work so well, right? So it's the idea that, hey, listen, you're putting money into this and it has a very specific trajectory that it's going to send that money and when it's going to come out to you and where it's going to come out. And it's really important that you understand that mix and how you can get the money out because, even Roth IRAs, they have opportunities to get money out prior to retirement, but they're very specific. We've done shows on that. So understanding the vehicle you're investing in is exceptionally important and what it's going to do for you, not just from an investment standpoint, but from a taxable standpoint, because that's really where we're breaking down everything today. We talked a little bit about the kind of the non-qualified or the after-tax investments. And, that's probably where the bulk of, the stuff that we do on the, kind of the, people come in, they're like, we're saving, we're trying to build our assets outside of retirement. We've got money in the bank or we inherited assets, not sure what to do with that. How do we mitigate wealth taxes? How do we get this invested? We want some liquidity to it. These are kind of that common story to the money that you want available now all the way to retirement and through retirement. This is kind of the liquidity bucket.
Yeah, I was just going to use that word. These are the dollars and these are the monies that we talk about as liquid to you, meaning that, access is at your discretion. There's no rules or limitations based on age or anything else, so it's there for you and it can be had. But the consideration there when accessing your liquidity is what's the tax consequence? And that's what we want to get into is how do you decipher what amongst all of your invested assets might be the most prudent opportunity to take if you need to pull some money out.
Yeah, well, we're going to get there for sure, and there's going to be a lot of that coming. So there's a number of different, I think, here we talked about all these different taxable and non-taxable and post-tax and pre-tax and all this stuff, and it's confusing in its own right for a lot of our listeners, I'm sure. But then you start adding the complexity of like all the different investments and how those intertwine, right, with the idea of like, well, where am I going to put this money? How do I put this money in a way that I see the least amount of tax or it's available? And it brings me back to kind of the funnel thinking. The first thing we have is the idea of, where would I have this after-tax money? I've inherited this money from my family, and that's a very common story walking through the door these days. But I don't need the money. Or I don't need all the money, or I don't need a big chunk of the money, but I don't want to pay taxes on it every year. Like, what would I do with that? That's one of those things that's really interesting too. We have a lot of people who, just don't want to pay ongoing taxes every day. And what's really unique is that you can take that after-tax dollars, you can take those investment dollars, you can put those in something like an annuity. An annuity will tax defer, those funds, so you don't have to pay taxes every year. A lot of people don't realize you can do that. Just like your IRA or 401k, you can have a tax-deferred asset on something that was already post-tax. So you inherit $100,000. You're not going to pay taxes on that $100,000. It's your money. But now you can stick it in a vehicle where it can grow, it can mature, it can have a return. But like the funnel, you can't touch it till 59.5.
Right. Yeah, that opportunity to defer gains, while participating in the market in a non-qualified sense is really unique. I mean, that is one of the benefits. I mean, it's really the only thing out there that kind of provides you that. But it does come with those rules, right? So the stipulation is that you're really setting this money aside until, what the IRS deems to be kind of early retirement age, 59.5.
I always kind of, think of the more the government gives you, the more restrictions they put on it, right? I mean, it's just kind of like, hey, listen, we'll give you the tax deferral, but you got to wait to 59.5. We'll defer it like a retirement plan. I mean, that's a really very valuable thing because, you could be at some unfortunately high tax levels, even if you weren't intending to be. We see that all the time. You got a bonus, you got this, you got that, and all of a sudden, you're in a tax bracket, or you inherited an IRA from your mom or dad, and all of a sudden you have more income than you ever normally would, and you've got to put yourself in a higher income tax bracket, and on top of that, you have other investments. And there's better times to take that money out or to absorb that tax hit. And I think some of these things can be mitigated just by how you structure the investments and where you're putting your money.
Yeah, there's no doubt that some investment products or tools, create taxes in different ways, and choosing appropriately the right type of account to hold that particular investment makes a lot of sense. And that's something that we give guidance on all the time, and it's how we construct and direct investments and portfolios on behalf of our clients is with these things in mind. And what that all kind of points back to, and kind of the crux of the conversation so far, is the word diversification. We counsel people on this frequently. When you talk about diversification in the world of investments, there's one immediate kind of definition that people come up with, and that's, you get your large cap, small cap, mid cap, international, domestic, this index or that one, and that truly is diversification for sure. And that just means you want to spread your investments out across the whole spectrum of classification or asset class there, so that if one's underperforming, the other may be balancing it out and lifting your values up. But the other type of diversification is tax diversification, which means, given tax code and what's going on politically 10, 15, 20 years from now, which is totally unpredictable, other than it's likely to be higher, if you have these different buckets to draw from that will be treated differently and potentially create less taxes day by day as you draw down income, it makes a lot of sense to build with those things in mind and to have those different buckets to dip into.
And one of the things that I think of, when I think of non-qualified, I think about the losses that people are facing here in this market, and the whole concept of our show is gaining from your losses. In the non-qualified world, and just using the annuity, for example, and how someone might utilize this space. Let's say you had a $100,000 investment, and it's pulled down to $80,000. You've lost the 20 or 25% the stock market's happened with. Well, you could sell that investment, okay, and realize that loss, meaning like you're going to put a paper loss into your tax return. You take a $20,000 investment loss that you can utilize against some other gain that you might have in your portfolio. You can utilize it, against other types of write-offs that potentially exist out there for you in various forms. And then you could actually take that money and move it over to an annuity. And let's say the market recovers, like people talk about it recovering by the end of the year and all the different things. And let's say it recovers from its $80,000 to $100,000. Well, now that non-qualified asset, you've articulated or realized that loss for some other financial reason. Now you've stuck it in an annuity that has now tax deferred the gain that you don't have to worry about this year in either realizing or trading. And you can manipulate the trades inside that asset. You can go from various types of investments in most of these programs, some mutual fund sub-accounts to other types of mutual fund sub-accounts, and not realize that program. A great opportunity if you want to create a loss in your portfolio and not worry about just, sitting the ride through and just seeing a $20,000 loss and gain back and forth.
Yeah, and getting into the the specific tax treatment of gains and losses, kind of the first thing to consider, and again, the title of the show is how do you make a loss into a gain, is to understand the holding period of each investment, right? Mm-hmm. So if you've held an investment for less than a year and you sell it, you're looking at either a short-term capital gain or a short-term capital loss, versus if you've held that same investment or a different investment over a year, now we're talking long-term capital gain or loss. And the tax treatment is significantly different in either of those scenarios. If you take it to the kind of highest tax bracket as an example, just to highlight the numbers in the extreme sense, you could be looking at, for a long-term capital gain, the maximum of a 23.8% tax hit, versus a short-term capital gain maximum 40.8%.
Almost twice as much.
Yeah, significant difference there. So understanding that holding period and finding yourself potentially in a situation where it may make sense to hold on to something just a little bit longer to get you over that year mark can have a significant impact on the bottom line.
That's a great point, Dan. And honestly, we're going to dig deeper into gains and losses and how to maximize these and how to address these as we kind of go through. We have some really good tricks of the trade that we do for clients coming up for you here in a short bit. If you have questions, you can give us a call at 855-226-8551 or email us at info@yourmoneyontap.com, because it's about your money. I'm Ben Brayshaw, joined here with Dan Michelon. Actually, Dan, kind of looking forward. Seth, I talked to Seth the other day, and I think he'll be back on the show here in the next week or two. I'm looking forward to that.
Yeah, it'll be great to have him back.
It'd be great to give him a hard time and push his buttons as much as we can. So thank you, everyone, for your prayers. And it'll be fun to have him back. Don't tell anyone I told you that, though. So we're talking about gaining from your losses. The idea of looking at the stock market and just kind of being in tears that you've lost money, and making the most out of it. There are a lot of things you can do. There's a ton of this that we can't even get into on the show. There's so much. It's just such a broader topic, and we're trying to give people some tangible takeaways that you can potentially do on your own. We did talk about taking the idea of selling an asset that's a post-tax asset. Taking that loss, realizing it, moving it over to a tax deferral investment program, and utilizing the ability to realize a loss to go against maybe another gain that you have to bring it into a tax year you want it. But we're actually talking about gains and losses, and just to kind of review people, the gain, a long-term capital gain is something you've owned for over a year. A short-term gain or loss is something you've owned under a year. And, short-term gains are taxed at the highest income tax rate that you're at, which would also potentially include the Obamacare 3.8% tax as well, which could be as high as 40.8%, which is astronomical to think that you pay 40% in taxes. And if you're in the high income tax bracket and it's long-term capital gains, you're looking at 23.8% potentially.
And then the other side of that coin is, if you're on the lower end of the income scale, as it stands right now, long-term capital gains could be zero for you.
Yeah, if you're married filing jointly under $80,000, yeah, you're looking at about 0%. You're looking at 0% because I think it's 83,000.
It's right there, yeah.
Yeah, so that's a real opportunity. So people, I've seen people where they've said, "Hey, I can." I actually talked to a gentleman who makes quite a bit of money, and we talked about how much cash he has on hand. He goes, "I could defer my income out of the company for XYZ a whole year, and then we could liquidate this, and I'd pay zero on capital gains taxes." There's real, there's ways to make the tax code work in your favor, and you just need to know those opportunities.
Yeah, that's another tax diversification tip right there, right? So being able to understand how to break down, the activity inside of a non-qualified portfolio by the end of the year to anticipate tax implications is, somewhat complicated. There's an art to it for sure, but there are ways to take a look at that so you can present to yourself the opportunity of a strategy called loss harvesting, right? Where as you approach the end of the year, you've realized that you've got gains, whether they be long or short term, in your portfolio. It's going to create a tax bill for you. There may be other assets you can cherry pick to sell and create that loss just to offset the future tax bill you've got, at least they're staring at for the following year.
Yeah, I mean, a lot of people have, I've got stocks that have significant gain, and I'm looking at other stocks and I'm saying to myself, you know what? This company's probably going to be underwater for a while, and maybe I'll realize the loss here and I'll realize the gain here and wash those out from each other. But then that brings into focus the wash sale rule,
right?
And the government knows that people do that, so they require that if you sell a stock or an ETF or mutual fund, that you can't buy a substantially identical investment for 30 days. Or otherwise, it's called the wash sale, and they don't allow you to deduct it.
Yeah, you can lose your loss if you don't mind that 30-day rule and make sure that if you are bouncing right back into another investment, you got to really be mindful of the substantially identical definition that the IRS uses, because it's less substantially identical than you might think.
Yeah, I know. It's not like sell Moderna and buy Moderna. Like that's the straight up obvious one, right? But it could be as simple as selling Moderna, and I don't know why that came to my mind, and buying Pfizer. I mean, it literally, if it's in the same context, but it even gets broader than that, because you could sell Moderna and go buy the ETF IBB, and all of a sudden, guess what? Because it has a substantial position in Moderna and Pfizer and all its competitors, because it's biotech, it's considered a problem.
Yeah, it can be very easily done in the mutual fund or ETF world, where you sell in one fund. The individual stock's a little bit different because you can generally understand what that company does or what asset class they might fall into. But in the mutual fund world, you can easily find yourself selling one S&P fund and buying another one from a totally different fund family, completely different scenario, or so you thought, and have yourself run afoul of this wash sale rule.
Yeah, and honestly, a lot of people don't even realize they're doing it. I mean, I think you make a really good point, because all of a sudden you sell one asset and it's large cap growth, and then you buy another one and you're like, well, it's large cap blend.
Yeah.
So, but meanwhile they all own Apple. So you got to just be careful, and that's one of those things. So we really encourage people to make sure that if you're going to take this strategy on hand, that you don't fall amiss to the wash sale rule, because then you've destroyed the whole opportunity here. That's one of the things where if you move from, like when we were talking about the non-qualified asset and selling that, taking your loss and moving into an annuity, you can actually switch investments. It could be almost exactly the same and it wouldn't even apply because of the investment strategy difference. So that's an interesting piece too, that kind of voids that issue, because you're going from an annually taxable non-qualified asset to a tax-deferred non-qualified asset, which takes all of that issue out of the play. So something that's very interesting, something worth considering, and so forth. So let's talk about, Dan, one thing people have a problem with is how do I figure out what my long and short-term capital gains and losses are, and how does that all work? Do you want to jump in there?
Yeah, I mean, so the first thing you got to do is identify which are long-term and which are short-term holdings for you, which is pretty simple to do. I mean, it's a 1 year rule, right? So if you've held it less than 1 year, it's short-term. Longer than a year, it's long-term. Pretty straightforward. But then what you need to do is take a look at your portfolio transactions overall for the course of a year, and break it down into, what was your short-term situation? Were you at a gain or at a loss for the year? And then similarly, your long-term positions that sold over the course of a year, did that create for you a net gain or a net loss?
Yeah. And the thing is that, as you're kind of going through this, and if you have net losses across the board, probably need to see somebody. But, usually what people have is they have some gains and some losses, and then, they offset it. So, at the end of the day, if you had $1,000 loss on the short term and you had, $2,000 gain on the long term, you can actually use those short terms to offset your long term. So you'd end up with a net, $1,000 long term gain. But that's after you do the short and long term math. I think that's what people need to understand, and they miss that a little bit.
Yeah. And you want to, if you do have some ability to create a deduction here, you obviously want to apply it to your short-term gains because they're at the higher tax rate. So you want to apply it there first, and then if there's anything remaining, you can push it into the long-term capital gains to offset what your tax bill may look like there. And if in the end you end up with a net loss through all of these calculations, you can apply up to $3,000 as a couple, married filing jointly, against your income, your wages, any other taxable income that you have on your return, up to the limit of $3,000. But if the loss was in fact greater than that, you got to keep in mind you can carry forward whatever the remaining loss is each and every year until it's fully exhausted at the $3,000 per year limit.
Exactly. So, Dan, this brings me to probably another debatable topic, which I think is really interesting and something we could probably go back and forth on for an entire 5 shows. But the idea of, dividend, high yield investment stocks or assets or whatever you want to call them, right? It could be bonds too, like interest and dividends, in a non-qualified or an after-tax account, because we do that regularly. So
yeah, I mean, that is you're creating taxes by doing it that way. All right, so that's what I was trying to get to there. But for people who are looking to take income in the current sense, you may be better off taking interest and dividend income versus either capital gains from selling positions in a portfolio or even from salary, like the gentleman you were speaking to before, who was willing to defer income out of his company and live off of some other means at a lesser tax rate.
Yeah, and I think this is where people, miss a little bit of the kind of the managing the taxable scenario piece. So I'm going to walk through this a little bit here. So the idea of, interest and dividend income coming into a portfolio. So if you're making a sizable amount of money, I mean, you might be in a 22 or 24% bracket. So if you go over, I think it's $83,000 jointly married, you're married filing jointly, you're at a 22% bracket. Okay. But interest and dividends tax federally is, 0, 15, and 20 based on your income level. So if you're making $80,000, you might be looking at like 15% income tax bracket on that money. So theoretically, you'd be paying less in taxes, on those things on dividend, and that's actually a strategy that you can use. But let's go backwards and say, hey, listen, I'm making under $40,000 a year. I'm in the 10% bracket. Well, you don't want necessarily, the dividend income. Like that could be a problem for you. Like, why do you want to pay higher taxes? So mitigating those kind of issues is really, really important in how you take your income and distributions. So even though there's 1,000 people, 100,000 people out there would say, don't own your high yield assets in a non-qualified investment, it actually might be your lowest tax bracket as an opportunity to continue to create what we call cost basis or assets you've already paid taxes on.
And that's separate from the conversation around, I know I believe this, I know, Ben, you believe this. We just think that world, that asset class, the dividend producing stock, are likely to perform. So if you're investing to make money, we feel strongly that that's where the significant upside in the market here as people flow to those types of instruments to create income specifically. Right.
So to be clear here, right? So if you're making between, I just looked at the number to make sure, between $83,351 all the way up to $517,000 of ordinary income, your tax bracket on dividends is only 15%, point A to point B. That's that's a vast majority of America right there. That's huge. But meanwhile, the 12% bracket, ends at $83,000 on the income level. So as you're kind of crossing that threshold, it's kind of like, man, I don't want any more income tax. I need to kill this thing. So that's one of those things where, but if you're under 80,000, you get zero taxes on dividends. So there's a lot of moving parts here. And as you're kind of guiding through this piece, it turns into a huge play, right? And that gets into a whole nother conversation about LIFO, which is last in, first out. And we talk about that regularly with clients because the last money in is the first money you get taxed on. But you can reverse LIFO in certain ways where you're taking your principal out or a portion of your principal out first, and you don't pay taxes on your principal. So you can keep your income tax rates down. And so there's all these manipulation pieces that you can do on top of addressing both your losses and your gains and how that's going to impact your taxes as you're looking at the whole picture come down that funnel and how much you get to keep.
Yeah, there's no doubt it gets complicated beyond, just picking the investments that'll perform well. It's also, ultimately how to use them best.
Yeah. We're coming right back. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And we're going to talk to you about the one last thing we're going to give you today, which is a huge takeaway on what is the best thing to do with your retirement plans when the market's down and how to take advantage of that. We'll be right back. Don't go anywhere.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
Now back to Money on Tap with Ben and Dan.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, joined here with Dan Michelon. We are finishing up in our show on gaining from your losses in the market. Thank you for bearing with me with my voice. I'm still hoping this thing comes back. It's getting tougher as the show goes on here, but it's been a good show, and I think there's a lot of value here. I know there's a lot of complexity here, and I hope if you're feeling a little lost in it, we're sorry for that. But we're happy to. You can talk with us 855-226-8551. Love to hear from you.
It's a complicated topic, and if it's piqued your interest or kind of got you scratching your head or at least wondering if this is an issue for you, if you could be doing things a little bit better, we welcome that call. But if you're going to walk away from the show with one thing that you can kind of put in your pocket and remember, I think this is going to be it.
This is definitely going to be it. And we do this regularly for our clients when the market moves like this. One thing a lot of people don't want to do with their IRA is sell something and take a loss. And they're not sure where the market's going to go, and they're not sure what to do. One of the greatest opportunities I think that exist for us is the idea that we can do a Roth conversion on an actual stock, an actual share, an actual piece of any asset you own from an IRA to a Roth when it's undervalued. So if you look at something as simple as Amazon was, $3,500, a few months ago, and now it's trading at, it's since split, but it dropped down to the low 2000s. But you might say, hey, I'm a long-term investor in a company like Amazon, and it's lost a third of its value. Well, you can convert your shares of Amazon, and you're only going to pay taxes on the value of the day in which it converts. So if you own one share, you're going to pay taxes, income taxes, on the $2,000 value of Amazon, even though it used to be worth $3,500. And you might then be able to just ride that stock right back up if that's where it's going. So a lot of people take advantage of Roth conversions and don't get lost in the idea that, hey, I've lost money in my retirement account. Look at this as your cheap, inexpensive way to get your money into a Roth at a much lower tax bracket, or at least a less of an income hit to you when you do convert those shares. You just get to convert more shares for whatever dollar amount you're willing to take on.
I mean, it's an incredible opportunity. Again, if you're holding a company or a position that you just really believe in, and you intend to hold it long term, and it's done well for you in the past, but is just suffering from the overall tide of the market, this is something to really, really consider. I mean, you can pay taxes on this thing at a depressed value one time, here and now, and never pay again.
Right. Your income taxes are gone for good after that. What a great opportunity. I mean, if you're down 20 or 30%, consider that a 20 or 30% tax deduction, tax incentive you're not going to pay on. This is a time, I've done it with my own portfolio this year. I've done it with clients' portfolios. There's different assets where you're like, hey, I'm a long-time holder of this asset. I'm like, let's convert it. I have clients who inherit stock and they're like, hey, it's down and, whatever. And it was like, let's move it. So there's opportunities for things that you can do in lots of different ways of when the market's down and how to move it, where to sell it, how to take advantage of making those losses work for you. Thank you for listening with us. We really appreciate it. We look forward to talking to you next week. Give us a call. Our number, you've heard it before, 855-226-8551. We'd love to connect with you. You can email us at info@yourmoneyontap.com. love for anybody who has show ideas to send them on over. We'd love to get that information, as they have been helpful in the past, and ideas that have led to other ideas. So we try to get that stuff in there. So thank you so much, and we look forward to seeing you next week. Make it a great one.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.